What if I tell you you can either get fried chicken or US Treasury bonds?
I'll take bonds,
What about Apple shares or bonds?
and I will take bonds.
What about GameStop shares or bonds?
Oh, no doubt, I will take bonds.
So, this is why the stock market went down this week. What about Tesla shares or bonds?
And trick question, but Tesla shares.
What?
Hi, trader. In today's video, we are going to explain why the stock market took a this week.
And as always, our stock picks of the week.
So be sure to watch till the end.
And give us a like and thumbs up if you find this helpful. Let's briefly look at the market real quick.
As we mentioned in the last week's video, we mentioned the critical support to be around 3800 and 3810 for S&P.
And in the past week, the market has tested this level multiple times and able to close slightly above it on Friday.
This means that the bulls and the bears are still fighting aggressively.
And we can see that from the market snapping back from the second support after piercing through the first support to make week high at 39.34.
And the market dropped right back down and closed at 3809 for the week. So what caused such high volatility?
Maybe everyone want to cash out to buy chicken nuggets, or dare I say bonds?
Absolutely, because the bond yields are the highest in the recent 12 months.
Which means after the 7-year bond yield spiked 14%, along with the 5-year and 10-year bonds, it just became a more attractive option than the stock market for many institutional investors.
But why would the institutional investors be interested in the bonds than stocks? Don't stocks have way higher returns?
Because as the yield continues to rise, the bond market is a safer bet than the bubbly stock market.
You may wonder what caused the bloodbath on Thursday in the stock market after the Treasury yield exploded after the catastrophic 7-year bond auctions.
Yeah, so foreign treasuries like Chinese and Japan, who are the common buyers, be like, "Nuh-uh, not today," which drove the yield bananas.
This attracted domestic institutions to rotate their cash from stock market to the bond market.
To put a few numbers in perspective, the 7-year bids for every dollar sold has been the lowest in a recent decade at $2.04, far below the recent average bid at 2.35.
That makes sense because no one was bidding and the Fed has to buy 40% of the bonds auctioned on Thursday, which was at the highest in the past 5 years.
Okay, to put it in simpler terms, when the bonds yield go up bigly, the stock market goes down bigly, and vice versa.
Bigly, huh? So looking into next week, we should monitor closely at the 1300 level, and also the STIMI package might finalize next week and the market will react accordingly.
I think if the package shrinks or delays, we might be looking at around 3750 level.
Finally, my favorite part of the video,
This should be interesting.
the NSFW picks of the week.
Let's do it.
Alright, my first pick is My first pick is DraftKings, important resistance level at around 64.81. There will be a buying opportunity at breakout. Remember, this will be one of the reopening stock.
My first one is Chipotle. I like their chicken bowl, and they are opening a new store right next to my house. It seemed to have rebounded from this past Tuesday. It's an expensive stock, but you can try to open a small position around 1400.
JD earning is on Monday. If the price drops to the bottom channel, that is a loading opportunity, roughly around 86, 87 price zone.
I think we've talked enough about Walmart last week. It is trading below 250-day moving average and at a nice support here. A buy for me personally.
I'm a buyer for Zoom between 355 to 360. Be on the lookout for the earning on Monday and have them order ready.
And YQ is the last one. Virtual education is going to be the future, so I'm a buyer if it goes near 13, especially as we move past pandemic and people getting used to the virtual environment.
Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.